BloombergQuint. The monetary policy review delivered a status quo on rates as expected. The stance remains accommodative, although there is a first sign of dissent emerging. And there was some change on the auction size of the variable reverse repo rate auctions that the RBI holds. What do we make of all of this, and what is the market in particular reading into it? Neeraj Gambhir, Head of Treasury at Axis Bank, joins us. Neeraj, afternoon. Thank you so much for taking the time to speak to us. First off, what did you make of the various bits and pieces, the forecast changes on inflation or the projection changes on inflation, the stance, the slight dissent emerging? How do we put it together?
So for me, I think the policy was pretty much along the expected lines, all the components of policy. Yes, the inflation forecast probably was a bit on the higher side. I think our estimate was about 5.5%, and they put it at 5.7%, but that's still within that range, right? So not that big a negative surprise, but yes. The dissent, I need to really understand what the dissent is about, because Professor Verma seems to have voted on the resolution to keep the keep the repo rate same, but the language says that there is some dissent around the language used on the accommodative policy stance. Now, did he want the policy stance accommodation to change? That could not have been done without something else changing around the policy. So I really need to see the minutes to understand what the dissent is about. So I'm not necessarily reading too much negative into it as yet, unless and until we get the details around the dissent. But I think all in all, accommodative policy, continuing to maintain the focus on growth, continuing to say that inflation is transitory, and they think that the inflation is transitory. And Dr. Patra in the post policy statements went to great length to explain as to how they're thinking about the inflation per se. I think these are all great details which tell us that we are still some time away from any kind of exit or lift off or whatever other word you want to use around it.
I'll focus on that inflation, sort of commentary from Dr. Patra. Actually, he made it very clear, because we were all wondering, what is sort of the trajectory back towards 4, given that is the midpoint of the target. And I think he made it very clear that they're intending to disinflate over a period of couple of years. So even if, for instance, we continue to see inflation in the 5 to 6% band, there is no reason to expect the RBI or the MPC to change their stance.
So there are two things here, Ira. One is that we are in a very extreme case of monetary policy right now, right? We are in a exceptionally loose monetary policy and liquidity situation driven by pandemic, right? As life returns to normalcy, some normalcy in monetary policy is also to be expected, right? That's part one. The part two is that inflation obviously is higher than the threshold, right? Or closer to the threshold, uncomfortably so. So does that warrant any kind of quote unquote tightening by the central bank, right? So my view is that normalcy will be driven by normalcy in real life, right? If we do have a somewhat milder third wave, which doesn't have as much of a severe impact as the second wave had, right? And the economic activity starts normalizing post that, then we should see some exit from extra loose monetary policy situation, a path towards normalcy. But that's normalcy. That's not reacting to a very high inflation situation as yet. That's not, as Dr. Patra says, that's not destroying the demand to bring inflation under control, right? That's still return to normalcy. And I think the situation where we actually start disinflating for the sake of disinflating for the sake of bringing inflation under control, I think is still quite some time away in my mind, right? We got to see a far better growth outcome, before we actually get to that point. So effectively what we are saying, if you think about this, it's a dreaded S word. It's basically saying that we have stagnation. We're still not very confident of the growth. And we have inflation, which is largely a supply side phenomena. So unless and until one of these things resolve, right, a supply side phenomena becomes a demand side phenomena, or stagnation in the growth converts itself into robust growth, we're not going to act upon inflation at this point in time. That's my read of the policy and the post-policy communication.
What's your own sense of the inflation picture right now, sir? I mean, having studied inflation in India for so long, what's your sense of it? And I don't mean whether it's coming from pulses, etc. As somebody else had pointed out, the drivers have changed. We have remained relatively elevated, and over a period when inflation was already, at reasonable levels. We didn't have very low inflation or anything like that. And on top of that, we have this surplus liquidity situation. We do have, sort of one section of the society, which are the large spenders, having a fair amount of money in their hands, plus, the positive effect that comes from buoyant capital markets, etc. Could that spending atop current inflation not just accelerate the price pressures?
It could, in a situation where your capacity utilization is running close to 70, 80%, right? And where your credit demand in the system is booming. People are actually borrowing for various kinds of spend, whether it's to buy houses, whether it's to buy cars, whether it's to buy personal goods, right? There is, for inflation to become endemic and become a sustained problem, it typically tends to happen two ways. One is what we call as adaptive expectations, right? Which is basically, if you have a persistently high inflation surprise, or rather, let me use the word, if you have a negative inflation surprise, which persists over a period of time, people tend to expect higher inflation in future, and then that itself, settles down in the system. A negative inflation shock of this nature, in the presence of surplus capacity in the system, right, typically peters away in any economic modeling. Now, that's what the central bank seems to be banking upon. That's exactly what Dr. Patra said, that, our capacity utilization is close to 60% currently. Yeah. They start worrying about inflation when the capacity utilization reaches 70% plus, right? Similarly, if you look at the banking sector's credit growth at this point in time, it's pretty anemic, 6%, 7%, right? Our best case scenario for this year is probably 8%. Even the retail credit growth is not as ebullient as it used to be, back in 2002, 2003, etc. So my point is that, yes, we have a theoretical construct. High money supply could potentially lead to inflation. But to me, there is a path in between, right? The high money supply has to convert itself into higher credit growth, higher demand, higher capacity utilization, and then that sort of sets itself up into inflation. The only caveat to this equation is that if inflation persists, it can become adaptive. And that's where the central bank may decide that even if we don't have high capacity utilization, low demand, we might need to act against inflation. I don't think we are there as yet. I think we're still about a year away from that kind of situation.
Okay, so that was going to be my next question. So any move on rates and even on reverse repo, I'm not just saying repo, is, you think, at least a year away?
No. Like I said, there are two parts to this equation. One is the normalization. Second is to act against the inflation, right? As far as the normalization is concerned, if we think about COVID third wave, if we give, let's say October is the time when everybody is talking about it, and if we give ourselves another 3 months after that to say that by that time we'll know how bad the COVID third wave is and what's the impact on the demand. I think we'll be somewhere in January or February, right? So hopefully by Jan-Feb, will be a very clear idea of what the pandemic situation is. We would have achieved a very high degree of vaccination, I think close to about 80% in the country as a whole. And that should give the central bank the confidence to start normalization. Okay. And my conception of start normalization is not withdrawal of liquidity. My conception of starting to normalize is to bring the corridor between repo and reverse repo to lower number, somewhere close to 25 basis points. It's pretty wide right now, right? So that's my conception. So we could have a situation going into February where, if everything else plays out, Reserve Bank will start thinking about narrowing the corridor, even if the systemic liquidity continues to be as surplus as it is today.
Why would they pick the narrowing of the corridor before they start to sort of suck out more liquidity? Would you explain that?
I think the surplus liquidity in the system is currently way too high. Yeah. If you look at the total aggregates across various components, right? The government cash balance with RBI, the surplus that banks are parking with Reserve Bank, etc., and the forwards that Reserve Bank has done, which is also another tool to manage the liquidity. I think the total surplus is somewhere close to 10 trillion INR, right? Maybe higher than that. Now, you cannot neutralize 10 trillion INR of surplus in a short period of time, right? Even if, let's take a theoretical situation where Reserve Bank stops anything, whether it's a forward purchase, whether it's spot purchase, whether it is OMOs in the government bond to add to the liquidity of the system, the natural rundown of this liquidity through currency creation will take us at least 3 years, right? So I don't think Reserve Bank is going to wait for and that's again my view, that they will not probably wait for liquidity conditions to normalize before normalizing the overnight rates. I think that sequencing will have to be played out slightly differently this time.
So they won't, for instance, say we'll stop the OMOs or the GSAP because that is coming from a different place.
They potentially they could continue with that. Even if they stop it, all they're going to do is, it's basically India's version of tapering.
Yeah.
What is tapering in the US? Tapering is simply US stopping to buy more bonds.
Yeah.
That's tapering, right? Our version of tapering will be Reserve Bank stopping to do GSEC OMOs.
Yeah.
Or FX intervention to some extent, right? I think even if that were to happen, this current surplus liquidity in the system is so large, it will take a fairly long period of time for it to be absorbed in the system through currency creation, right?
Yeah.
That's the point that I was trying to make.
Understood. This, I think the argument even from the RBI side that this surplus liquidity is not leading to credit creation and hence, from an inflationary perspective, perhaps not as worrying or damaging. What's preventing that? Is that just the sort of risk aversion, etc., in the banking system, which is preventing banks from stepping up on credit? And again, do we foresee that changing? And if it does, then obviously it has a bearing on the inflation discussion that we just had earlier.
See, sitting inside a commercial bank today, I can tell you for sure that it's not necessarily risk aversion, okay, right? As a bank, we are open to do business, right? And sort of, particularly, and we've said this, right? We are looking to grow our balance sheet. We are looking to do more business on both retail as well as on the wholesale side. The key challenge is that what is the credit demand of the kind that you want to do, right? The lending that you want to do in the system, right? So we are actually hoping for some capex related demand to come back into the system, et cetera, et cetera. So I think the point that I'm making is that it is not risk aversion by the bankers, right? It is not necessarily risk aversion by all the banking system. It's also to do with what is the kind of credit demand that is existing in the economy at this point in time. Even for retail side, there is some impact on the credit demand because of people thinking about their future, their job stability, etc., right? So unless and until that normalizes and we see a solid credit demand coming into the system, I don't think the credit growth will show a substantial uptick.
Okay. Just switching focus a little bit to the bond market. So I think between last policy and this policy, we did see rates move up. There was a lot of consternation that the RBI was stamping down at least the 10-year. They've allowed it to move up, although I don't know if that's only because you moved to a new benchmark and control is limited right now. But do you see sort of, the move towards 620 and then maybe to 625 and beyond sustaining? Will the RBI let it go beyond that? Because there are some people who are saying that by March, you'll be at about 650. You see that as possible?
I think it's possible that by March will be 650. I think the point is that market does expect Reserve Bank to start normalization, right? And it's fairly evident. I mean, if you look at the OIS swap curve pricing, for example, of forward of future, right, overnight rates, the swap curve is telling us that by February we will be the overnight is going to be at 4%, and in another 6 months after that will probably be another 50 basis points higher. So market is expecting a normalization and will start pricing in a normalization. I think it'll be only fair for Reserve Bank to allow the market to price in that normalization, right? Therefore, yes, there is a very overriding objective at this point in time to make sure that the government's finances are taken care of, right? The government is able to fund itself at a meaningful rate. And the fact that all, interest rates are driven with G6 as the underlying, G6 yields as the underlying. But I think in general, we will see a return to normalcy will bring higher rates in all the major economies in the world. And I do expect in India also, we will see something similar happen.
Some of the anomalies that had cropped up along the curve because of the RBI focusing too much on the benchmark, have they eased out now? Is the curve looking sort of more logical?
It is still there. I think if you see the amount of adjustment that has happened in the shorter end of the curve, particularly going up to 5 years, is far more higher than the adjustment that has happened as the 10-year part of the curve, right? We still have those sort of distortions, so to say, in the system. They become somewhat lesser after 10 years has been allowed to adjust. So let us see how that plays out. I think it's only a question of time to see as to how these things play out, right?
And some of sort of the has the mood of the bond market broadened to include slightly lower rated borrowers, etc. Has at least the surplus liquidity helped push through money via the bond markets, if not via the banking system?
I don't think we have seen a meaningful change as far as the credit risk appetite of the bond market is concerned, right? We still are very focused on AAA, AA names. We still see very rare single A names getting traded in the market. Spreads, I think, would actually significantly increase if you were a single A rate issuer coming into the market. But as far as the market's appetite for AAA assets is concerned, that has become quite significant. So if you see the spread of a AAA bond versus G-Secs at about 35-40 basis points for a PSU, it's actually at the lowest in a fairly long period of time. And this spread is actually lower than the spread on STLs. So on the one hand, the bond market is showing some appetite for credit, but that still is very polarized and very high grade credits.
So two last questions. One is on the government side of things. So I think there is some comfort, right? The early numbers coming in for the fiscal year are looking good. In fact, the cash balances with the RBI are quite high. So the bond market probably has some comfort there that we should be able to meet the targeted fiscal goals for the year.
Absolutely. I think the question mark around fiscal arithmetic is becoming less and less so, right? As there has been recovery in this thing. The only thing is some of the large privatization program, how and when they will go through. And the good thing is that equity markets are also buoyant. So if the government wants to really push through some of these privatization programs, then the markets are conducive for it, right? Yeah. And if that happens, that will give the bond market even greater comfort that now at least the government's finances will not worsen from what we have seen. And hopefully over the next 2 to 3 years, as the economy normalizes, we will see some normalization of government's finances as well.
So my last question was on global markets. I think there's been quite a significant shift in the way at least US bond markets were moving just a few months ago and how they are now. What's your own sense of what the scenario in the US bond markets is? And you're fearing about premature tightening here because of what was happening there. Some of those fears slightly lessened right now. So the great reflation trade seems to be dead. Yes. Right. I don't know why. Yeah. No, I think that it happens kind of very suddenly, very quickly in about a 2 weeks period, right? When people, as soon as Fed realized and started to talk about tapering, I think the market developed some kind of cold fever, right? And it feels like that now people's views around growth seem to have tapered down a bit. There is probably an expectation that data coming out of US will be on the softer side as we go forward. So it seems like the Fed is doing again a very tightrope walk, pretty much like in India. So as soon as the 10-year US yields started to inch towards 1%, you had Fed Vice Chair come in and talk about tapering this year itself, right? And that pushed the 10-year yield back up to 120, 125. So, I think the tapering is pretty much on the cards. My view is it's going to be starting next calendar. And they will obviously advertise it. So the Jackson Hole meeting next week is extremely important. And I think as the confidence around economic recovery grows and hopefully Delta variant is not as severe, you will see Fed taper. I think liftoff is probably another year away. At that point, we need to start watching the currency a bit more closely domestically as well. Is that the key determinant for the currency? Because I think on the current accounts front, things are relatively predictable. In fact, some positivity if the exports pick up the way they have been in recent months. So on currency side, I think it's a dynamic interplay between how well US does versus what is our own economic situation, right? If US recovers and India also recovers at around the same time, you could argue that, yes, there will be more demand and hence higher current account deficit. But you could also say that at the same point in time, the concerns around India's credit rating will go away. Yeah. So we could see some flows back into the bond market in the country, right, given where the yields are. So I think it's a bit of a dynamic overplay. I'm not too bearish on INR at this point in time. I think we'll probably coast along the same lines.
and some mild depreciation is quite possible, simply driven by the fact that dollar could be a bit stronger if US economic growth turns out to be a bit higher and Fed indeed starts tapering.
All right, got that. Neeraj, Gambhir, thank you so much. As always, crystal clear conversation there on monetary policy and markets. Thanks for watching.
Pleasure talking to you. Thanks for having me on the show. Bye.